Two huge mistakes that dividend investors are making right now in the stock market. You might be making one of these two mistakes right now in the stock market. That's what I'm sharing with you guys here today. By the way, welcome to the Financial Education channel. If you're new here, I am Jeremy. I want to share something that's going to potentially save you guys a lot of money. There's two traps that I call in dividend investing that suck people in and they end up just losing a lot of money by getting involved with these two things. I personally got involved with both these things. As someone that's in the stock market, you almost think there's like a bunch of ways you can kind of one up the system. There's like another smarter way you can do things. And these two ways trap a ton of people getting involved with dividend investing stocks, which, by the way, dividend investing is a beautiful, beautiful thing, okay? Dividend investing is amazing. Why? Because you guys basically just hold a stock, they pay you out all this dividend money, you go ahead and you reinvest that dividend money into the same stock or different stocks. You get to continue to build your wealth by basically just holding stocks. It's an awesome, awesome thing, okay? Dividend investing is beautiful, but there's some things people get trapped into that I just kind of want to explain to you guys so you can hopefully save yourselves a lot of money. And by the way, I want to let you guys know, if you got the Becoming Master of the Stock Market course in the past, I just uploaded 5 new lessons to it. Well, 4 in-depth lessons. One's an intro called Dividend Investing Mastery. So if you've ever gotten that course in the past, literally once you log in, you can watch the whole new lectures. And there's 4 lectures. One, I go into how to tell if a dividend is safe, all the metrics you need to be looking at to actually tell if a dividend is safe or not, because a lot of people invest in stocks and the dividends they invest in aren't even safe dividends, okay? I talk about what makes a great dividend stock, all the metrics you need to look at, all the things you need to think about when picking a great dividend stock. I go into examples of actual companies, public companies that I feel are great dividend stocks. That's a very helpful lesson. And then the last lesson's on how to build a great diversified dividend portfolio. So if you've ever gotten that course in the past, literally log in and all the lectures should be up for you now. If you want to go ahead and get that course, I got a 70% off today for you guys that watch this video. So if you want to go ahead and take advantage of that and get that entire course, it's a lot more of dividend investing. It goes into what I look for in stocks and all those sorts of things. So if you want to check out that course, I'll probably have it as a pinned comment. And if you've gotten in the past, that's uploaded now. Okay, guys, let's get into this. All right, guys, the first huge mistake dividend investors make in the stock market, they get trapped into this. It's basically something that actually happens in the short term, okay? It's basically a short-term play that some dividend investors think is a very smart move. It's like, oh man, I found this way around the system. This is such a smart thing, okay? This is what a lot of people think, okay? So basically what they'll do is they'll go ahead and buy a stock right before that stock goes, X dividend date, okay? The X dividend date, which is usually the date you have to hold a stock on, okay? So the stock's about to go X dividend. As soon as they held that stock through the X dividend date, then their plan is the next trading day is to basically sell that same stock, okay? So sell whatever shares I bought in that stock. So I'm gonna go ahead, I'm gonna buy the stock right before it's gonna go X dividend, which is the date I need to hold it to, and then right after that day that I need to hold the stock to, then I'm going to go ahead and sell my shares. And this is going to be a brilliant idea. And why do they think this is a brilliant idea? Well, basically what they think is they can collect the dividend, okay? So they think they're going to be able to collect the dividend and go ahead and take advantage of that, and then basically just sell out of the stock the next day, and hopefully they made a bunch of money on the dividend. Hopefully the stock didn't move much. It's only a day or two difference, and they went ahead and sold that stock, okay? So when a friend and I got caught into this trap very bad, okay? We thought we were so smart we could up the system, okay? So what we did, we thought about this. We're like, oh my gosh, this is so smart. You buy it X dividend date, you sell it on the next day whenever you can sell it, and you can still collect the dividend. This is so smart. So we buy into the stock. I think it was yielding something like an 8% yield, okay? And we're like, oh my gosh, why has no one else figured this out? Oh my gosh, we're gonna make so much money from this new plan. We're gonna climb to the sky. This is beautiful, okay? So we go ahead and we execute this, and the payable day comes, okay? So payable day comes, and you go ahead and you actually collect your dividend. But the issue is, here's the issue, okay? In the stock market, after the X dividend date, whatever the amount of money that is paid out in dividend, the stock has to open up that down the next day, okay? So basically meaning, I think the stock paid us around $1 per share or something like that. Meaning the next day after, okay, the day after basically, the stock has to open down $1, okay? It's something the exchanges do because people probably try to figure out this system in the past, okay? So it has to open, down $1 essentially if that's what they paid out. If it, let's say it was 10 cents, the company paid out a 10-cent dividend. That next day, guess what ends up happening? The stock's gonna open down 10 cents a share, okay? So what ends up happening is you don't gain at all in the system. Actually, you end up usually either breaking even or a lot of times losing money unless you get really lucky and maybe the stock market just happens to take off that day and the stock market has an unbelievable day. Maybe this can reverse course and that next day when you go to sell your stock, maybe you can sell it for somewhere around break even and maybe actually make a profit on it, okay? But usually that comes few and far between, okay? And what we found is usually that's not the case. And the stock will actually open that next day, the day you're supposed to sell the stock, it will actually open more negative than whatever you collected in the dividend payment, okay? Which is obviously a very bad thing. So let's say you collect $1 per share in dividend payment. A lot of times that stock will open, negative $1.25 or negative $1.50 or something like that. And a lot of times it will trade under, basically $1 plus down that next day if it paid out $1 dividend. So really, you end up losing money in the whole situation, and you're very lucky if you can break even and just make a slight profit, guys. And so this is just a huge dividend trap a lot of people get caught into. It's a little short-term play that a lot of people think, oh my gosh, I figured out a way around the system. Just believe me, guys. Imagine how many very intelligent people have, come and gone in the stock market over the past 100+ years, right? And if there's some magical way of just getting ridiculous gains, because imagine if this actually worked. Imagine the type of gains you could get. You could get hundreds of % gains per year or thousands of %. If it was actually literally possible without cheating the system, okay, like actually using inside information or something like that, if it was actually possible to get hundreds of % gain per year or thousands of % gain a year, like consistently, that would have been figured out a long time ago, and we'd have people worth trillions and trillions of dollars, and we'd all be like, Warren Buffett, Jeff Bezos, who cares about those guys? They're nobodies. Look at this guy. He gets thousands of % gain or hundreds of % gain, because literally you could just go stock by stock and just do that day in and day out. Every day the market's open, look at the biggest dividend stock, go ahead and buy that stock, then go ahead and sell it. Like, it doesn't work, guys. Just kind of think about it. Like, people would have figured this out a long time ago and would have already gained the system, okay? So that's the first one. It's a short-term dividend play. The next one is even a bigger one that a lot of people get caught into. This trap will lose you, unfortunately, a lot of money. Alrighty guys, this next one costs people more money than any dividend investing mistake out there. And basically what you have happen is a massive amount of dividend investors get caught into just looking at the yield, okay? They look at the dividend yield, and based upon that dividend yield, they judge if a stock is a good dividend stock or a bad dividend stock. And I can tell you, this is the last thing you should be looking at, okay? This is literally the last thing you should be looking at as a dividend investor. There are so many factors that go into picking great dividend stocks for the long term rather than just looking at a yield. So people are like, oh, if it pays a 1% or 2% yield, it's a bad dividend stock. When it's like, okay, if you're planning to hold this stock 5, 10, 15 years, which a lot of dividend investors, like usually it's a good decision to hold long term, right? Buying a company you believe in, you've researched them fully, you believe in them a lot, you believe they're going to raise dividends. There's a ton of different factors to look at. So a lot of people think 1-2% yield currently equals bad dividend stock. And I can tell you that is 100% false. If you're looking at it that way, you're looking at it the wrong way. And so they think like, oh, if it pays a 3% or a 5% or a 7% yield, this is a really great dividend stock. And I'm just telling you, if you're viewing it that way, you're viewing this game 100% incorrect. And here's why, guys. There are a lot of metrics that are very important, such as payout ratio, okay? If you invest, let's say you invest in some stock that's paying, a 4% yield that you think is such a high yielder, and this stock's doing great. If it pays out, if it's got a 95% payout ratio, 85% payout ratio, how much are they really going to be able to raise that dividend in the future? You're probably going to get no dividend raises in the future, and then they're getting so close there with the payout ratio that, guess what? That 4% yield might end up dropping in the future. Why? Because they end up not having enough money to pay out, and so therefore they have to cut the dividend actually, okay? So just looking at, whatever it's yielding, think about this. What about the competitive environment, okay? What about competition, okay? What about the competition? This is something you should always factor in when picking dividend stocks. What if somebody comes comes in and knocks your dividend stock off, meaning like they actually, start losing market share in whatever they do. They actually start losing business. Their net income, okay? What if their net income starts downtrending or is downtrending consistently, okay? Let's say this company was earning $1 billion of net income a few years ago. Now they're earning, let's say, $500 million. Okay, we've got a downtrending dividend stock. Let's say the stock is paying a 6% yield right now. Is that really a good dividend stock? When their competition is eating their lunch, when net income's just, fallen 50% over the past few years, is this really a good dividend stock just because it pays a 6% yield? Absolutely not, because you know what's going to end up happening? A cut is coming, okay? A massive dividend cut is coming. There's so many dividend investors that fall into this trap all the time. General Electric is a perfect example of a company that dividend investors fell for the trap. General Electric was yielding a very high rate. I think it was sometime around this time last year, actually. General Electric was yielding a very high, basically yield, okay? I think their yield was like 7 or 8 or maybe 9%. And then next thing you know, they cut it to nothing, okay? So your great dividend stock you found that had a 7% yield or 8% yield that you thought was so phenomenal, guess what? Their business had been downtrending for years. Their business had a ton of issues. You should have been looking into the business more and not just saying, oh my gosh, the stock has a 7 or 8% yield. I see it all the time where somebody thinks they found such a great dividend stock because it pays a 10% yield and they get so excited like, oh my gosh, I found this stock. It pays a 10% yield. Oh my gosh, I'm gonna make so much money. I'm gonna make 10% of my money a year and not even have to do anything. It's so unbelievable. And guess what ends up happening? That company a lot of times is actually paying out more money in dividends than their earnings per share. And a lot of times they're actually issuing debt, okay? They're actually issuing debt to go ahead and fund this really high dividend payout, okay? The only stocks I give a pass to when it comes to paying out, most of their EPS is basically what I call REITs, okay? A REIT is a real estate investment trust, and for tax reasons, a REIT has to pay out a minimum of 90% of their earnings per share basically in the form of dividends, okay? So if it's not a REIT, which most dividend stocks are not REITs, okay? If it's not a REIT, then if it has a super high payout ratio and their net income's downtrending, I'm just telling you guys, you're going to end up getting caught into a situation where you lose a lot of money because more than likely that dividend is going to be cut. And what always happens when a company cuts their dividends, I see it consistently. A stock will drop 30%. A stock will drop 50%. You can go through stock after stock that had a huge dividend yield, 5%, 7%, 9%, whatever, a ton of these companies. And what you will find is once they cut those dividends or it starts getting close, like people start talking, oh man, that company might cut their dividend. Who ends up selling off the stock heavy? Dividend investors, because that dividend investor is not going to be investing in a company that doesn't pay dividends. And what you'll see across tons of these stocks, look at their stock charts. Tons of them go down 30%, 40%, 50%, 60%. And so you think you bought such a great stock and they pay you out that great dividend a couple quarters in a row, but meanwhile you just took a 30% loss, 40% loss, 50% loss on a stock that was not a good stock. And maybe they could potentially go bankrupt. So that's something you guys gotta think about in this game. Don't get caught up into how big the yield is. Get caught up into the million different other factors you really should be looking at in this game, guys. So don't get caught up into those mistakes and you'll save yourself a lot of money in this, guys. So anyways, I hope you enjoyed this. By the way, once again, if you've gotten that Becoming Master of the Stock Market course in the past, it's going to be the pinned comment down there that's got the full dividend investing mastery course in it now, along with all the other lessons. So hope you guys enjoy that. Thank you for watching and have a great day.